Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Well, this week we witnessed a striking global divide with the 16th annual BRICS Summit running concurrently with the International Monetary Fund and World Bank meetings. Now, significant developments emerged from BRICS, including a rare meeting between Chinese President Xi and Indian Prime Minister Modi. Now, this comes just days after they agreed to ease a 4-year military standoff along the Himalayan border that they share. Russian President Vladimir Putin made headlines too, declaring the formation of what he called a, quote, New World Order. And in addition to Xi and Modi, nearly 20 global leaders attended, including Turkey's President Erdogan and United Nations Secretary General Antonio Guterres. The BRICS alliance seems to be expanding, with Putin claiming that over 30 countries are interested in joining. Of course, those details on this potential growth remain uncertain. And on the economic front, BRICS leaders propose initiatives like a grain exchange and a cross-border payment system, underlining their intent to reshape global influence. Now, Russia also announced talks with BRIC members to establish an international precious metals exchange, aiming to ensure fair pricing and to bolster trade. Meanwhile, the IMF has issued strong warnings in its latest global financial stability report, noting that markets might be underestimating the risk of the geopolitical tensions we're seeing. And the IMF cautioned about a dangerous disconnect that could lead to a sell-off similar to the panic that we saw back in August. Now, the World Economic Outlook for 2024 also lowered the global growth rate to 3.2%, down from 3.3% in July, citing mounting risks from conflicts and, of course, rising trade protectionism. And our next guest believes America is headed into what he calls one of the most challenging economic, social, and political periods in history. Joining us now to analyze the latest international and domestic developments and to share his projections, of course, on the rest of 2024 and beyond is Peter Grandich. Peter specializes in retirement business and estate planning. He's got over 4 decades of experience in the financial markets. He's managed several hedge funds, even had a mutual fund named after him. Of course, Peter has written several books, including The Confessions of a Wall Street Whiz Kid. He's also the founder of PeterGrandich.com, a blogger, a podcaster, a widely followed commentator, and of course, you know him well here at Kitco. Peter, welcome back.
Always a pleasure and an honor to be part of Kitco.
Thanks, my friend. Let's talk right about BRICS. We'll jump right into it. I mean, you heard me mention the summit off the top. We went into some details. I know that you were watching this quite closely, Peter. What were the key takeaways for you from this event?
Well, to begin with, Jeremy, I have called the formation of the BRICS and the inevitable reaching somewhere within the next 2 years, because I started 2 years ago with a 3 to 5 year expectation that when they're all said and done, when they reach whatever their peak may be, what they will have done to world commerce will be equated to what the Industrial Revolution did to world commerce. It is a Bretton Woods 2 in motion. And what we saw now is a much more increase from last year. And what I think people are failing to recognize, that all keep expecting everything to happen at once, they are really doing it through a very organized and manageable and, quite frankly, doable method. And I think, unfortunately, my other concern is that the don't worry, be happy crowd that has infiltrated Wall Street for years has paid no heed to this. And I think they're going to be in for an awful shock within a couple of years to realize how formidable the BRICS have come. The one important thing is to keep this in mind, what I tell everybody when BRICS are mentioned. Just think that whatever countries are involved in this and end up trading with each other, they have done so to avoid trading with the United States and also using its currency. How that is a positive compared to when they used to is beyond imaginable. And I don't think it's taken into the equation here when people think about investments.
Yeah, interesting. I mean, we did see that the Kazan Declaration was issued by the BRICS group right after the summit in Russia. Let's talk a little bit about this. I found it interesting. There was this one line on the international financial systems reform. It says, quote, we underscore the need to reform the current international financial architecture to meet the global financial challenges. Obviously, people are starting to pay attention here, Peter.
Oh, they are. I mean, where they've paid attention, and one of the key reasons why I was such a bull on gold is what's transpired with gold. This accumulation of gold by central banks across the board was not from an investment standpoint. It was a recognition that a major change is afoot, and eventually gold will play a more important role than it might have played in the last several decades. And therefore, that was another factor. And while they have not yet, and nor did I expect them at this meeting, to announce the specifics of their unit currency and how gold will play a role, they have given us enough of an inkling to suggest it will be part of a role. Now, of course, and I don't want to jump ahead of any questions you may have, it's to buy the rumors, sell the news, and that may what be happening with gold temporarily. But I think it's been another contributing factor to the great rise in the gold market is what's happening at the BRICS.
Yeah, a lot of people obviously paying attention. I mean, we didn't see any major gold-backed currency announcements as we were kind of anticipating, maybe speculating as you just talked about. But with the BRICS seeming to focus on continuing to increase trade in national currencies, I mean, how do you see this developing going forward? Break it down for us.
Well, I think it comes at a time when I think you can start to question the European Union to begin with. Think about Germany. When I started in this business in the dinosaur age of the early 80s, Germany was a true economic powerhouse. It is now struggling to stay afloat. And you can go through much of Europe and see similar situations. At the same time, here in North America, the two former great trading partners, Canada and the US, are both having series of problems on the economic side and also social and political. And therefore, the BRICS have really a jump start. They're not up against the formality that we might have been 10 or 20 years ago. But I think the most important thing that the number one selling point for the BRICS is not only what we did, including with our European partners, to Russia when the Ukraine war broke out, freezing their assets, but then taking the interest that those assets earn and giving it to their enemy really was a calling card to all countries saying, hey, if they did it to us, they can do it to you. And I think that will come back, and historians will look at that as a key factor and all. But all in all, the BRICS are moving in a methodical method, a kind of a friend of mine likes to say drip, 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 boom, drip, 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 boom. And that's how they're working. And I think anybody, especially if you look at the news when the Ukraine-Russia war broke out, how everybody predicted the end of Russia, the crumbling of it, the exact opposite has happened for them.
Mm-hmm. Yeah, it's so interesting. I mean, you mentioned there this development of what they're calling UNIT. Of course, BRICS nations are considering trying to, have the introduction of this new currency. Talk to me a little bit about how important this is and what we kind of saw this time around.
Well, the most important thing is we're not involved in it, neither your great country, Canada, or the U.S. I think that's an important thing to start with.
Yeah.
I think the second other thing is that the fact that they even announced that they want to form a precious metals exchange. We've already seen how the Shanghai exchange has taken over the dominance that London and New York used to have in the gold market. There's some very serious thought out thinking here. And one of the things that didn't get really a lot of news other than quick shots of photos was that India and China came to peace with their border. I mean, one of the things that used to be negative about the BRICS was the argument was, oh, India and China will never get along. They're almost ready to go to war. That's a great turnaround. That's one of the big pluses of this meeting that didn't get a lot of coverage. And it plays a role in the future and how things are going to go. Because when you start thinking about China and India together, size, economics, people, human beings, military, what have you, that's a formidable group.
Peter, even though de-dollarization is accelerating, the dollar still represents around 58% of reserves. That is according to the International Monetary Fund's data. I mean, this is compared to nearly 73% back in 2001. So, I mean, when will we really start to feel that the dollar is losing its reserve status here?
Well, that's a big drop, Jeremy, if you think about it, 15% in a few years. And really the dollar, what it has going for it, it's the best of the least. In other words, realistically, if you looked at anything else that's currently available, there's nothing that stands out. The euro, the Japanese yen, all the issues that are happening in Japan and all. But the most important quote you made there is we're down to 58%. And I think when we get under 50%, and that will probably be after next year's BRICS summit, when we see how many more countries come into foe and how advanced they are with this new trading system that they're talking about. And I think by then we will learn how they plan on using the unit, what formula. I mean, right now, this chat, 40% gold, the rest currencies. They may not even yet be at their own number, but I think the dollar's days, in a sense, are numbered. Now, I don't think it's crashing. I don't think it's going to be worthless, but it's moving definitely in the wrong direction.
Yeah, it's been fascinating. Obviously, as a reminder to our viewers, the BRICS Alliance was founded in 2006 by Brazil, Russia, India, China, South Africa joining in 2010. It seems to be growing. I mean, it's expanding at a huge pace. It includes South Africa, Egypt, Ethiopia, Iran, of course, the United Arab Emirates. Saudi Arabia did attend the BRICS summit in Kazan, but, this week the status remains unclear as to whether or not it's accepted the invite. I'm curious here, what are you watching for in the next year when it comes to BRICS? I mean, they seem to be getting closer and closer.
Well, I think the Saudi Arabia is kind of playing both sides at the moment.
Yeah.
I mean, there's still an influence. There's so much happening in the Middle East now. We're probably the closest to a very serious war we've been in decades, and a lot of things can evolve. And I think that's one of the reasons they didn't want to commit. I think the things to look for now is how many more countries join. What more do we learn about their system on how they trade? And quite frankly, it's going to play a lot role on who wins our presidency, because one person who's running is talking about huge tariffs, which play into what those guys got together for to avoid such things of that nature, and how will that play a role? So there's still a lot of moving pieces, but the pieces for the BRICS are moving in the right direction. And the G7, the old man on the block, they have a lot of difficulties. It's hard to look at any of the members of the G7 and say they're a formidable foe for the BRICS as they continue to grow.
Yeah, historical meeting to say the least. Okay, well, Peter, what's your take on the IMF and the World Bank meetings we saw this week? I mean, we learned that the global public debt is set to hit an unprecedented milestone this year, surpassing $100 trillion, according to the IMF. I mean, by the end of 2024, global public debt is projected to reach 93% of worldwide GDP and could approach 100% by 2030, if you can believe it. Now, this would exceed the previous high seen during the COVID-19 pandemic and obviously represents a significant jump. How will the U.S. fare in all of this? I mean, the U.S.'s own national debt is quickly approaching $36 trillion.
Jeremy, I didn't know what a trillion was when I started in the business. Yeah. Never thought we'd use the word T in the investment world, but here we are. The Congressional Budget Office here in America, probably one of the last places that have some bipartisanship left, now has hiked their outlook to 54 trillion U.S. debt before 2034. And by the way, that's without any recessions happening, which would speed up if it occurs. At $50 trillion and a 5% interest rate, we'd have $2.5 trillion in interest expense. The best year we ever had is just under $5 trillion in revenue. So even if that increases a little, we're going to get to the point where paying interest is going to be a serious problem. And the government is clearly not going to be able to provide services, including defense and other things that people have grown accustomed to now. And it's not alone here in the world, as we just pointed out. All this debt has to go somewhere. So I think that's part of the reason also that if you look at many of the key members in Asia, in this Asian group that's basically dominating the BRICS now, they've been net sellers of U.S. securities and bonds. They're not going long that anymore. So there's a debt doomsday out there. The difference now, Jeremy, is it's no longer, well, it's so far out we can not worry about it anymore. Yeah. Most people watching this video will be alive when this debt crisis really hits front and center here in the U.S.
Yeah, no, well said. And when you think about that, I mean, we're going into this upcoming election. Of course, we'll get to that in a moment. But, we're looking at the Fed. I mean, when we think about debt and we think about that stimulus, they've really put themselves into quite the arena here, Peter. I mean, what has the Fed been doing? Are they on the right track?
They've been behind for quite some time, Jeremy. There's one of the most brilliant men that worked on Wall Street is still alive. His name is Stanley Druckenmiller. In fact, if tomorrow he would be willing to take my money, I would sell all my holdings and just give it him to manage. That's how brilliant I think he is and what an opportunity that would be. And he has now made a huge bet against the bond market. And he has started to recognize, as some others had, that we are getting to a point, especially with the out of control deficits now running multi-trillions of dollars, that we could see a huge spike in interest rates, whether or not there's a strength in the economy or what have you, because of concerns of our credibility. And we've seen that now. If you think about, we had a 50 basis point cut, and rates are higher now than they were before the cut. And so, I think the Fed is pausing now about whatever they might have thought of. Certainly, I don't believe there'll be a cut in November. And there may not even be one in December, particularly if interest rates keep rising. So there's a lot of issues. And I think one of the things is the Fed has really lost the ability to manipulate and move markets in the manner that it used to. And part of that is because of much of the dominance of world trade and interest is moving away from the United States, not towards it, as you noted, just on ownership of the dollar. So I don't think it's the power that it once was.
Yeah, we saw that jump, the 50 basis point cut from the Fed in September, as you mentioned. The next meeting is scheduled for November 7th with the CME FedWatch tool pricing in a 96% chance of a 25 basis point cut here. So your outlook, you're saying we're not going to get it. You don't think that we should be going after that one, or like Canada just did last week, too?
Yeah, well, we're seeing... We've heard a word that I haven't heard since the 1980s, when we used to have interest rates at 15 cents being tossed around by some very smart people on Wall Street. There's not many of them, but the ones that are very smart. And it's called bond vigilantes. People better start watching. There's a great concern now among people that live and breathe the credit market each day that we could see a major spike in interest rates, even though the economy may not warrant it. And if these people see it, the Fed are smart enough to see it as well. And so I wouldn't go to the bank that we're going to have this cut in November. A lot will to do with the few economic numbers that come out, and also whether or not they want to be viewed as political. Some people, I was one in the camp that believed the 50 basis point had an extra 0.25 political wise. But whether that was or isn't, I think people need to pay attention in the coming weeks. If interest rates keep moving up, even if with economic numbers not supporting it, we have a crisis brewing in the bond market.
Yeah, of course, we continue to see that data coming in and then being revised as well. Okay, well, you've stated in your reports that this potentially is the worst era in the U.S.'s history, economically, socially, politically. Explain to me, Peter, and to our audience, what specific trends or warning signs have led you to this strong assessment?
Well, there's 10 of them, and I call it about building a financial arc. The first we covered is the debt. The second is a retirement crisis of great proportion. The third is a continuing overrun of immigration and the economic woes that causes. The fourth we talked about was the BRICS. The fifth is very interesting, and I think it's going to be clear and evident in less than 2 weeks. The political parties can't even go in the same room together anymore, Jeremy. I mean, they literally cannot come together to do anything that's needed in this country. And I think it's only going to get worse. And therefore, if there is a crisis, bond crisis, whatever it may be, well, we don't have the political willpower and all. But there are another five that I've talked about most recently, and that is, and we've seen it, the natural disasters, the cost to natural disasters. The infrastructure in the United States is really about, in a sense, crumbling. And the amount of dollars that is going to be needed in all to fix it is a huge crisis. A couple of the others is the freedom of speech, the ways of society, how it used to be versus how some people want to control it now. Unfortunately, the movement of what people coin radical Islam, but really a different way of living and thinking that certain people want and others don't. And in some places that never thought they would see it now are facing that. And then finally, just the fact that people have been living beyond their means. You know, I continue to see people in our planning group, Jeremy, from all walks of life, at all works of levels, even the athletes I dealt with. And I say 7 out of 10 are living at least one lifestyle above their finances. People say, how do they do it? Well, they continue to mortgage their homes, buy high car leases, don't save for retirements. And we need to develop a less is more attitude, because the government's going to be in a less of a position to help us as things get worse than they were maybe in a past generation. So I really think there's enough issues out there. And let me just say this, the complacency among the financial community now, given all of this, compared to what other things have happened, including what got my claim to fame, the calling the 87 crash and all. We are in such more dire situation than any time before. But you wouldn't know that if you listen to a lot what comes out of Wall Street.
Yeah, interesting. And I mean, to your point, we're seeing some crazy debt levels, people living beyond their means, but I'm also feeling it with the pocketbooks. I mean, so then let's dive into that a little bit here, Peter. I mean, given what you just talked about, what's your macro outlook for the end of this year and maybe into the start of 2025? I mean, is the U.S. in store for a recession? Is it already here? What are your thoughts?
Well, my big issue is this, Jeremy. I think it's an important one. The bottom 50% of wage earners in the U.S., or half the wage earners, almost 50% of them, or 25% of the entire workforce now in the United States, is using credit cards to pay for simple day-to-day needs, whether that be gas, food, clothing, rent, etc. When the masses get to the point where they have to, in a sense, use credit cards, and eventually that runs into an issue because the debt piles up so higher, and that's why we're seeing such a great increase in credit card delinquencies, that upper echelon can't avoid it. Eventually it hits them too. Now, it may not hit them that they're going to be out in the street, but the booming economy that they usually make a lot of money off of is just not going to happen. And as I noted earlier, one of the other issues we have here is we have a retirement and aging crisis. And it may take a minute, it is important. 2/3 of Americans are working paycheck to paycheck right now. They are not able to save for retirement. In fact, all different studies from all different groups have shown that the vast majority of people are not going to be able to retire like those financial commercials show and how you live happily ever after for your last 20 or 25% of your life. The bottom line with that also causes an aging crisis because eventually boomers like me are going to peak and pass. And with that, so will our wealth. And that wealth will move to a younger generation, and politicians go where the wealth is. So sooner or later, those younger people are going to say, listen, you're taxing us to death to pay for this Grandich at 80, 85 years old that wants a big lung transplant. No. So we're going to have an aging crisis and a battle of the ages too, the way things are going. And this is why I just say I don't see most people prepared for it. I like to say that it's better to be a live chicken versus a dead duck, because even if I'm wrong and somehow Nirvana does return, we'll still be in a position to enjoy it. But if I'm half right or fully right, most people are not prepared for it.
Yeah, you talked about when you called that accurate, crisis and that crash back in the 80s. I mean, how bad is it going to get here, Peter? We're looking at the stock market right now. Historically, are we going to witness a sell-off worse?
I think part of the things that happened in 87 was there weren't safeguards in place. So I don't expect the 20 or 25% down date, no matter what transpires, barring the unbelievable, terrible thing that none of us can imagine. What I do think is the market will start to underperform over the coming years. So my interest with people is, if you're concerned about the next day or week or month, I'm not the guy to listen to or talk to. If you're concerned about the next several years, I do think it's going to be more challenging to see the returns that we have seen in the past. And a lot of people's lifestyles is still betting on that. And that's where I think the trouble is going to rise. It's going to be not so much how much you lose, how much you make, but how much you don't lose over the next few years, which are going to separate the true winners from the losers.
Yeah, it's interesting. And much to your point, I mean, we also had this report from strategists at Goldman Sachs who think that the era of the big stock market returns is basically over, Peter. So, they claim that the S&P 500 will return just 3% a year for the next decade and 1% after adjusting for inflation. So to your point, I mean, do you expect a big stock correction in the near future?
Well, that was a little surprising for me because that's a group that basically makes money on stocks and bonds in the market moving forward. So to have that courage to make that type of call, I at least commend them for it, not just because they happen to concur with my thought, but just to make that in general. I do think people need to start to look and be serious about and saying, okay, what if I don't make all the money I hope I'm going to make? Because what happens is when people invested, they've already in their mind discounted how much a stock or their investments are going to make and how they're going to spend it. Try not to take the best case scenario. Try to take a lesser than best case scenario and make sure you can both financially and mentally live through that. Once we do that, once I show people how they're spending more they take in, once I'm showing them how if they lessen that and return that to the positive side of their balance sheet, there's a peace of mind that people don't talk about, Jeremy. There's a peace of mind that you hear when people have reduced or got out of debt or lessen financial burdens. They talk about a day of walking around almost in a sense on cloud nine. And that's not spoken about in the financial service industry because most people in the financial service industry haven't experienced mental anguish from losses in finances. And I think it's very critical for people to understand that there's a mental strain and a mental risk when you're investing, not just a financial risk.
Yeah, interesting. I mean, I can't believe I'm going to say it, but we're about a week away, a week and a half away from the U.S. elections. I'm kind of curious here. Are the markets underpricing anything right now? Are you looking at any areas where you could take profit over the next little while to November 5th?
Well, that's so short-term, not just me. I do think that the metals market has moved a lot, and a lot of it had to do with the brick. And I would expect some consolidation there and even a little corrective phase. It wouldn't hurt. I think there's enough melt up type of momentum still among the Wall Street people, especially once we get into the latter part of November, December. Eventually it's called the Santa Claus rally. But most people pick up a cheer that they might have not had for the rest of the year. And it becomes much more difficult to think about selling stocks and bah humbug guys like Grandich. But I do think if your outlook is past the next few weeks and months and you really still invest for the long term, this is a good period of time to adjust for that so you can go into 2025 in a better frame of mind and hopefully a better framed portfolio.
Okay, well then, Peter, let's talk about precious metals and your outlook there. I mean, we just saw gold hit multiple record highs this week, currently trading at around $27.50 an ounce, up 33% year to date. I mean, silver hit 12-year highs, and then even palladium's up more than 10% this week, trading above 1,200. Let's start with gold. What's your take on the rally and what we're seeing? Because obviously BRICS just happened, but it seems like it's a little bit bigger than just that.
Well, for a person that in 2021 sold stocks just to own gold, I'm quite pleased what's transpired. I mean, this has been a phenomenal rally, maybe even faster and bigger than I thought it would get to. But I do think that it is extended. There are a couple fundamental things that can keep it going, including, a breakout of a war, which seems very, very close in the Middle East and all. But I do think it's deserving of a consolidation period. And all bull markets need to have corrective phases. I don't think it's anywhere near the end. I said when it was well under 2,000 that we can get to 3,000. I said we'll see 3,000 without ever seeing it under 2,000 again. Nothing's changed on that end. I even think silver now, something that was not, I used to get a little people angry. I used to say silver was like kissing your sister compared to owning gold. But that's no longer the case. The fundamental argument there has improved dramatically. Plus, there's a huge short position as well. And so I think that both do well. I would sooner own them still than, say, general equities. But I think a timeout and a period of consolidation now is good for it. Now, markets don't always do what you think is good for it. But if it happens, I won't be disappointed.
Okay, so a little bit of a healthy profit taking. I mean, do you expect some big correction through the year end, or you're still kind of bullish on that 3,000?
Yeah, I don't, if you mean like a 10 or 20, no, I don't think there's too much demand. The world has changed. People forget not only how much physical gold bullion has been purchased, but also how many countries have repatriated their gold from the US and London to own it. This is all happening because they recognize that gold is becoming a more important role in the world monetary system. So I don't think I'll tell you this, I don't think there's a 20, 30, 40% correction in gold, period. I do think it's possible in general equities. And that's what I think, another thing that gold has over equities. I don't think it can lose anywhere near as much of what it's gained as the equity market can.
Interesting. Peter, hypothetically, I mean, if this BRICS unit currency comes out, what's that going to do to gold? And when does that happen? What is that going to do to the gold prices?
Well, it's probably at least a year away. I still think they're probably a year or two away. I do think it would demonstrate that gold has become a viable part of monetary systems, and a system that is clearly where more people are moving towards versus away from our SWIFT and the US dollar. But what people don't talk about in that is, if we are correct about that end, what happens to all the dollars that are still out there that those countries aren't using anymore? They come back to the homeland, which becomes very, very inflationary for the United States and a big issue down the road. And no one has asked either one that I know of, president candidate, not that one I think could even answer, hey, what about the BRICS? What if this all happens? How is this going to impact the U.S.? And it'd be interesting to see that, particularly if Trump wins, because Trump has at least said up to through the election that he's a great believer in tariffs. And that plays into their role. That plays into what they've said, why people around the world need to move away from us. So it's going to be a very interesting time on the world stage. And like I said, I think when it's all said and done, it's going to have as much of an impact how the world changes economically as the Industrial Revolution did.
Yeah, can't believe we're a week and a half away. Okay, before I leave you, you said that the time has come for junior resource stocks to shine. We've been hearing some of this rhetoric about, equity prices are going to finally catch up to the metal prices. And in a lot of cases, they haven't. So, what market conditions make you particularly optimistic about the sector now?
We were having such a good interview. Why'd you have to ruin it at the end here by talking like that?
I just want to, because good ROI, Peter, good ROI.
I've lost more money in the junior market than I ever imagined as a young man I would ever have. So maybe I'm not the best person to answer, but I'll give it a stab. If the metal prices maintain these levels, that there isn't a huge fall back of $1,000 in gold or something, the logic thinking is there needs to be replenishment. Look at Newmont Mining. They've had a poor earnings report. But what's interesting about it is they're still basically at 5 to 6 million ounces a year in production that they were 10 or 15 years ago. So they haven't been able to greatly add to their reserves. And the problem has been is most of the world has not seen real expansion of looking for metals. In fact, in many places, it's declined because people are concerned about going there. So the inevitable reaching down to juniors who tend to be the earliest people that find mines and potential mines, et cetera, is inevitable. The issue still remains the competition. The people who used to be in the junior market, some of them are not and may never be back. They've gone into cryptocurrency. They've shied away from mining in general. They're heavily involved in the technology era and all. Plus, it's big challenging now for a junior resource company to get exposure. Much of the people that used to play that, individual brokers that built a book of business around owning these things because they were commissions, don't exist anymore. So they're not the buyer or the end user. So these little junior companies have to find those end users more on a one-to-one basis versus one person delivering 50 to 500. It's much more challenging regulatory, where they're operating, et cetera. But with all that said, I have stated, and they'll come back and they can save this interview, that unlike the previous years, I am absolutely convinced the bottom in the juniors has occurred or will occur by the end of the year. So if this time next year they went lower, well, guess what? Grandich was wrong again.
Well, certainly a lot of viewers hoping that that's not the case. Okay, I want to end on this. Yeah. I want to end on your 10 commandments. I was reading, and I encourage anyone to go to your website to read about this 10 commandments for the storm upon us thesis. But, one of them I want to read here, Peter. I got to get my reading glasses, but it's not how much you make, but how much you don't lose, which will separate the winners from the losers. So I guess my big question is here, we've been talking about potential crisis. As you mentioned, we're coming into a very interesting time. A lot of things not answered here. As an investor and for our viewers, how do you prepare for a crisis like that?
Yeah, I think there's a saying that I think you should put on your computer, and that is, it's more important now for capital preservation than capital appreciation. Don't spend as much time trying to figure out how you can make $1 into 3, 4, or 5. Spend enough time on how your dollar doesn't turn into 50 cents or a quarter. And I think that's the big change. I think we have to get used to that when it's not going to be as easy as it once was in the general markets in general. And I just think life around us is going to be that much more challenging. And the real motto of the Grandich household and the Grandich planning group is, it's a very simple 3 words: less is more. It really is. We don't need all the stuff. I can go out and buy a bigger house still. I can go out and buy a bigger car, but it's going to cause more of a financial strain that I'm quite happy in the dwelling I'm at and the car that gets me from point A to point B. The world, unfortunately, because what it sees is being told you're only happy if you get those bigger cars and bigger houses and all. But in real life, that's not the case. Some of the most happiest people you will meet are people with little or no means.
Yeah, well, I mean, look at, we look at some of the Warren Buffetts of the world still driving their old sedans. I mean, it's interesting, though. Warren Buffett is all cash, or at least increasing his cash position. I mean, we just talked about that de-dollarization trend. Is there still some value in just holding cash in this market?
Has it been bad to bet against Warren Buffett? Yeah, if you bet against him versus on him. And I think that when the Stanley Druckers and the Warren Buffetts are doing these things, you should at least try to pay attention. And maybe your 5 or 10 year in the business financial advisor may not be as much up to snuff as those gentlemen are.
Yeah, well said. All right, Peter Grandich from the petergrandich.com joining us from New Jersey. Thanks for this, Peter. As always, we appreciate your time. We appreciate you coming on Kitco.
Well, I thank Kitco for not only having me on, but the great work that you guys do. I wouldn't imagine if I couldn't turn on my computer and couldn't see Kitco. So keep up the good work.
I appreciate that. Well, we'll get lots after this election to get to. We'll have you on soon, Peter. Thank you. Have a great day.
Thank you. God bless.
I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We got great content coming up all week, so be sure to hit that notification button, hit the subscribe button. We'll see you next time.